Jobs, the big story for the markets. December jobs coming in a little bit below expectations. Payrolls up 199,000 for the month versus an estimated 422,000. But the good news, the unemployment rate falling to 3.9% from 4.2% in November. Let's bring in Jeff Sherman, Deputy CIO at DoubleLine Capital. On the bond market, Jeff, this just accelerated the Treasury sell-off that we have seen to start the year, which is one of the worst ever beginnings for bonds. What's the market interpretation of that jobs report?
Well, I think the market didn't look at the headline number. It looked underneath the surface as it usually does. And although you referenced the 199,000 jobs being a little bit weak and below expectations, when you look at the revisions within the report for both the October and the November data, you got almost another 140,000 jobs. So you put that together with the jobs print we got, maybe we get closer to expectations if you look at those revisions. And a lot of people think that that number from December may be revised upward. But the bond market, I think, looked at the average hourly earnings data. And if you look at the month-over-month increase in wages, once again, I think that was the thing that the bond market continued its sell-off, because it looks to see that it's going to allow the Fed to continue on its path of tapering, as well as eliciting liftoff from these low levels.
And that wage number was strong, 4.7% jump from where we were last year. More than expected. Yeah, and interestingly, Jeff, it expanded beyond leisure and hospitality, which shows that it's a little bit more persistent and widespread. We saw it in wholesale trade, a big jump in wages, financial services, education, really across the economy. What does that do to the inflation picture?
Well, it continues to keep pressure there. And I think that's why it emboldens the Fed at this point. And also, Sarah, there was a revision upward to last month's wage number to where the year-over-year growth last month was 5.1%. So it is very robust in terms of that participation. You couple this with the JOLTS data we got earlier in the week, which is the job openings, very strong in the quit rates across various segments. Yes, the most was within leisure, but there was a lot of white-collar workers as well that were quitting jobs. So this continues to keep pressure on inflation. And so we get CPI next week. We expect it to print with north of a 7 handle, likely to be about 7.1% or so. And then we continue to see pressure over the next couple of prints as well. So what I think this does is this allows the Fed to continue with their rhetoric. They're going to try to hike rates. The market now has a March hike almost completely priced in. And I think that allows the Fed to do so. The market is saying it's okay to do so. We're already prepared for it. And so I think it just allows the Fed to really accelerate this path of rate hikes that they really want to do at this point to combat these levels of inflation.
So Jeff, that's rate hikes. What are the chances, though, of a kind of violent reaction, a sudden and pronounced reaction when they stop buying bonds, particularly to the long end of the curve? I guess people expect it to keep rising. It's done half of that in the space of a week already. But could we be massively underestimating the impact?
Well, I think massively is a strong word there, Wilfred. I think really the expectation for the taper have been there. Chairman Powell set this up towards the end of November when he talked about increasing the pace of the taper, that is buying less bonds quicker, and that we'll be out of that program, or the Fed will be out of that purchase program by the end of by the middle to end of March. And so the market's already set up for that. So if you look at the supply demand dynamics of the Treasury market, when you remove the Fed buying, it's almost completely offset by a reduction of issuance of Treasury. So when we talk about the supply demand dynamics of the market, even though you're losing a big buyer, there's some of that supply being removed. Now, the wild card, Wilfred, is if we indeed get like a Build Back Better, or we start to do more fiscal stimulus programs over the course of the year, that will increase that Treasury issuance. So I think the back end of the curve is priced already for this reduction of purchases. I think the bigger wild card, what we saw on Wednesday, is the Fed minutes. What we saw when those were released was that they're talking about reducing the size of the balance sheet. So that also becomes a more tightening behavior. So yes, we have marginal tightening from the standpoint of less buying, but if they're going to let these securities roll off, and again, because we have to run a deficit, that means more treasuries have to be issued. That means also there'll be this new supply of securities coming out there. So at the margin, if they want to do this balance sheet reduction quicker, which people such as Bullard and Waller have been talking about, then potentially that is a net negative for yields and could lead for a catalyst for higher rates. But I just want to point everyone out, that this has been a global rate sell-off as well. This is just not a U.S. phenomenon that we've seen this week. There's been carnage across the global market. So that relative value trade still stays intact. But that means also just because yields have risen in the U.S., there isn't this natural buyer in the Eurozone because their rates have moved commensurately as well.
So wrap it all up, Jeff, given some of this risky business that the Fed is going to embark on, where is DoubleLine on where bonds go and where stocks go along with that for this year? And maybe the dollar too, because we've seen such giant moves in the first week. I think we've seen yield on the 10-year move up about half of what analysts were expecting for the entire 22 just this week.
Yeah, well, all those natural buyers, there were supposedly all these buyers out there at 170 on the 10-year, and they forgot to show up this week. And that's because of the velocity of the move, as you talked about as well. But I think in general, this is going to be a year where rate volatility is what's going to drive risk assets as well. And you've seen it already this year. As rates move up, I heard in the intro talking and Mike Stantoli talking about, the tech stocks getting hit. They're a long duration asset as growth is. So they're sensitive to interest rate movements. So I think really as you look throughout the year, it's going to be focused on the rates market. And you talk about the dollar. Well, if we have pari passu moves in the Eurozone and global rates, that just says that the dollar kind of stays where it's at this point in time. And so the market already has these hikes priced in. So when it comes to the dollar, we're looking to see this trading range it's been in for a while. It's just staying in these areas. As you well know, we're long-term bearish on the dollar, but for the near term, we're somewhat neutral on it because there really isn't this directional breakout. What that means for stocks is that if we push up another 25 or 30 basis points lower in rates, I think it continues to be slightly negative for stocks. But as you said at the onset, too, there has been this rotation to the more value type of place, which benefit from either a steeper yield curve or higher rates. I'm not convinced that the yield curve necessarily goes steeper because I really think that the 2-year is the thing that is going to continue to ratchet upward as the market continues to digest Fed behavior. And if you look at the 5-year, the 10-year, the 30-year, you see that they're all roughly at either at or above pre-pandemic levels. And so the 2-year is the one that's about half a point or about 60 basis points below the levels it was trading pre-pandemic. So that's the part that has room to run. And now, although a lot of us focus on kind of what 10s and 30s are telling us about the economy, I think the 2-year is kind of a dangerous part of the curve right now.
Jeff Sherman, great to see you as always. Thanks so much.
Thanks, Wilfred. Happy New Year.